Business journalist Ramah Nyang is our guest this morning. City, you had 1,017 questions.
You know, this role of the central bank vis-a-vis the role of commercial banks, it has to be, and it always has been, an ongoing concern. At what point does one feel that the central bank is overstepping their bounds or the mandate that they have? And at what point are they actually protecting the economy, and at what point are they protecting the citizenry? And on what point are the banks simply seeking to do that which they do well, make money, and make huge monies at that? I mean, it's a discussion that, unless it's broken down so that one can understand where and what it is that the conversation ought to be to stabilize this thing. You see, I look at the huge profits our banks make on a yearly basis, and I go, hey, even when we have all these problems, you guys are still making these huge amounts of money. Now, of course, it isn't as though they are robbing the wananchi. No. They are trading with the government. That we understand. Because the government is probably their biggest trading partner. But when
they're lending a lot to government.
Yes.
Huge amounts of it.
Yes. And the government are willing to pay. And it's safe. For the banks, it's a good place to actually do business. But on this issue of foreign exchange, are we saying that the central bank has not only overstepped the boundaries that are set for them, but they are the ones who have caused the problem?
They have created... trying to choose my words carefully here. They have not helped the situation in many ways. So here's a couple of things. So initially, when there were conversations around what's going on in the FX market, why are we seeing a divergence between the rates that I get as a buyer of FX when I go into my bank versus what I'm supposedly seeing being reported on trading platforms, Bloomberg, Reuters, and so on and so forth. And one of the first missteps that I remember happening was in, I believe it was Q4 2020, there was an analyst report that was put out that sort of tried to explain. This was from Standard Bank. It was actually written by the Standard Bank, so the parent company, Economic Research Desk. And they basically explained exactly what was going on. There's a divergence in the market. There's a fear of putting up, proper prices of trades that are happening on the trading platform for fear of retaliation from the central bank. The net effect of that is that it's creating this other quote-unquote, it's moving trades to the bank client side. So those essentially will not necessarily get updated on the trading platform. When you get to a point where a tier one bank here puts out a statement, a full-page statement in the papers, disowning analyst reports from its own teams, the impression you're giving is that we will brook no dissent on this matter. You will not speak about this at all. Step one. Step two, when the central bank was being asked about these things in Monetary Policy Committee
discussions,
by reporters, the response was, what dollar shortage are you people talking about? What dollar shortage? There is no dollar shortage. Which one? It's you people who are creating this problem. Now, the impression that essentially creates in the market is that we have a regulator who's either disengaged completely from the reality of the matter, or they're simply not interested in dealing with the problem as it is. So the way the central bank handled this in the last 2-3 years certainly has not helped matters, because people will see that a regulator who's saying there's no problem at all, then they go to their bank and they say, hang on, I'm looking for $100,000. Can you find it for me? And the bank says, no. We don't have that cash now. And the net result of that is that people say, okay, I'm going to vote with my wallet. And what have they done? You dollarize. Or in some cases, as is the case with the stock market, every time we speak to equity investors or bond investors here, their number one question is always, what's your dollar situation like? Will I actually get paid? It's a big concern. And the way this thing has been handled by the central bank has not helped.
What is the advantage to not speaking the truth about the situation economically?
In the short run, you're essentially trying to sort of hope the problem might be transient, it might go away. The problem is this. Here we're dealing with a confluence of factors, and obviously there's a macro dimension to all of this. 2020 pandemic hits, demand for virtually everything shuts down, right? We're not driving as much, so fuel demand goes down, fertilizer demand goes down, import demand goes down. So import demand goes down, that helps the dollar. Takes our exchange rate. It helps the shilling. Takes the pressure off the exchange rate. But once you start reopening things, 2021, 2022, demand for that fuel, demand for jet fuel, for petrol, for diesel, for fertilizer, for imported goods, it all goes up. So now you have this surge in demand that you need to meet, right? And your dollar inflows are not necessarily where they were, because portfolio investors would have looked at the Kenyan stock market and said, in a pandemic, do I really want to have my money parked up in some random frontier market somewhere? Probably better off parking it in another emerging market, Vietnam, for example, which is often, mentioned in peer comparisons. Nigeria is not as a favorite now because similar problems. And the net result of that is, people decide, I'm going to move my cash out. But in the long run, you can only maintain that illusion for so long. At some point, the illusion starts to break. Because today, the argument that the central bank will make is, no, but we have a functioning market. If you go to your bank, you can meet these orders. But as we say, the proof is in the pudding. And manufacturers that I speak to say, we're still struggling to find the dollars we need to meet our daily requirements.
Is the hoarding component one that should be, so saying in terms of, flow, there is none. Isn't that what we're saying? And
there's some flow.
If certain things happen.
At a decent price.
Right.
And that's the problem. There's no price discovery. So people will be like, no, I'm not going to offload. I'm not going to come into the market, say, for example, as a tea farmer.
Right.
Or a custodian of tea farmers' finances, and offload dollars into the market at whatever the official rate is, 139.09 something, which I think was yesterday's number. Yet I know that there are people I can sell it to at 145, 146, as I would not be meeting my account holders' interests by leaving money on the table. And individually, that makes sense. From a macro perspective, it looks like hoarding, because essentially what I would be doing is holding on to this cash because I know there's a prospect for a better return.
Right.
But it isn't hoarding. It's just price discovery simply isn't there.
Now, it's clear when you're looking at it at this point, then it's clear really what is happening then in the market. And then that could then again, it lends to the reasons as to why you would have, certain dips and, bumps in the economy here and there. We can't take away the forex aspect from all of this. We cannot. It all lends to the economy conversation. These are different threads then that would make up the forecast. And then again, the question is, who then is advising? Before we hear these things that are being said, who then advises? And are these components of that advice
being paid attention to? I don't think so, because being a central banker is it's an extraordinarily precarious, hugely important job. And part of the job involves telling very unpleasant truths to the executive, because fiscal policy, right? So spending and taxing versus monetary policy, money supply, interest rates. They need to work together most of the time. But that does not by default imply that monetary policy is supposed to be a slave, essentially, to the physical side, right? And if you look at the bigger picture, right? Let's even ignore, currency inflows and currency outflows. Let's ignore the fact that we've got our structural issues. Our exports, tea, coffee, horticulture, whatever, have not really been, we're still sort of stuck in the same model that we've had basically going back to the 90s. And manufacturing back then was a much bigger portion of GDP. In the last 10 years, it shrunk to something under 8%. So the whole dream about, going to become a manufacturing powerhouse clearly never happened. Let's put that to the side. If you look at what has happened on the fiscal side, right, that entire period of low rates, easy money from 2008 to around 2020, you could go into the market as a frontier country and say, hey guys, I want to borrow $1 billion. And people would literally give you ask for $1 billion. Here's 4. Here's 4 billion.
You can have 4.
Give you 4. Every single bond issuance from some subscribers, in fact, actually all of our bids, all of our Eurobonds, oversubscribed.
Yeah.
A lot of them. The Kenyan government basically went on this massive fulizaing spree, and we didn't fuliza in shillings. Because if you fuliza in shillings, this FX maneno will not be an issue.
Right.
We fuliza in dollars, right? Now, if you think about, say, for example, the rail line, right? When those deals were signed, the dollar shilling rate was at 85, right? Today, realistically, 140. So, in shilling terms, your debt load has moved up by almost 40%. Right? It's huge. And if you're on the fiscal side, if you're a central banker, you'd probably ask, guys, the sensible thing to do here would be to renegotiate.
Yeah.
Right?
Yeah.
Some of these loans. Try and figure out a way of making sure that your debt service costs do not overwhelm you. But in our context, in our political context, and it's not just a Kenya problem, it's a Ghana problem, it's a Nigeria problem, it's most other countries. Are you willing to actually have those conversations in public? Because between themselves, I'm pretty sure that some of these conversations may have been had. But even if they have, as a central banker, you probably would not come out into the public domain and say, this is what I've said to the executive.
I've advised the National Treasury to actually consider 1, 2, 3.
Or we disagree with the executive on this, that, and the other. Because again, optics matter. But at some point, you have to start asking yourself, what's more important? The long-term economic stability and the painful medicine that we have to essentially take versus, and in this case, it would be, the unpleasant truths. Let the currency actually float properly. Unfortunately, the net effect of that is your debt service is going to be
So because of the political stick that the fiscal side has, we can say that the fiscal side is basically controlling the monetary side.
Essentially. And on paper, that should not be the case. Because
it should be like a counterbalance.
Yeah, because there's a reason why the central bank, if we appoint you a central bank governor, there's a reason why you essentially have security in that position. Because central bank government, we tend to think of that position as being very, staid, boring, dealing with a whole bunch of numbers, and most of us don't understand. It's an extraordinarily important role. Central bank governors, with the words that they utter, can wreck economies, and they're justifiably very cautious in some of the things that they end up saying and doing. And the reason why, at least in our case, we have security of tenure, for central bank government, can just be removed for frivolous reasons. You're not going to pull a Lamido Sanusi on you here, which is what happened in Nigeria, I think around 2014. The reason you have that is so that, you can actually have the room to make these difficult calls. And in our case, there are difficult calls to be made.
There's what's been in the news lately is the central bank introducing a new forex code. What does that mean?
Basically, sort of rules of the road. So you have to trade in a certain way. You have to keep, some of them is basic housekeeping stuff that in some cases banks have already been working on. So for example, if I'm an FX trader and CT is my client, I cannot communicate to him on WhatsApp. No. We're negotiating a deal. I'll tell you, okay, this is what is on offer. This is what I have available. This is a spread. This is a markup I am charging you. I have to make these things, these full disclosures to him on an approved trading platform. So either I'm communicating that on email or I'm communicating that on a trading platform, be it Bloomberg or the one that used to be part of Reuters, Refinitiv. Keep your records properly. Have a clear mechanism for all these records to be accessible, not just to you within the bank and your auditors, but also
to the regulator.
Yes, and of course to your bank board as well. The market has had a slightly surprised reaction, though, to the introduction of the code. It was telegraphed, because if you look at the letter of intent that the governor, the current finance CS, Professor Njoroge, sent over to the IMF, I believe it was late last year, they basically said, look, here's the code that we're going to introduce. It is based on, the global FX code that the Bank for International Settlements has worked on, or rather has helped to develop. And the beef that the market has now is they're saying, hang on, this thing is introduced on the 23rd. We're told the effective date is also the 23rd. But then you have to essentially get it into full implementation by the end of the year. And the market is like, where was consultation?
So they're saying there was no public participation.
No, well, I mean, for them, it's not even a question of public participation as such. But it's like, you wake up in the morning and it's just, okay, here are the rules.
From today, these are the rules. And you have
and you're already on the pitch.
The next 8 months to fully comply.
Yeah, it's basically, like me saying, okay, I'm changing the offside rules and we've already started playing.
Yes.
So that's raised a few eyebrows in the banking sector.
Okay.
Whether or not it'll actually change things, I'm yet to be convinced. And, I could be wrong on this, but I think that the shortening of spreads that you're talking about, because it's seen the spreads, at around 10, 11 shillings.
Yes.
I think yesterday I looked at some of the numbers, it was narrowing to around 8 or so. The narrowing of spreads would probably have a bit more to do with trying to take off some of that immediate demand for dollars from the oil market, because our biggest import component really is fuel, right, every month. But even that deal, the one that Chirchir and Co. have struck, there are a couple of questions around that, because what that seems to do is essentially remove the dollar demand from being an immediate thing now, and you're pushing it. Yeah, you're just pushing it out to like 6 months. So you're not, and then moving the FX risk from, or rather the responsibility to find those dollars from oil marketing companies. You're then pushing that FX risk onto banks' books, because they're the ones who are issuing those letters of credit. So if you're a fuel retailer here, no biggie, you see, you're billing your customers in shillings.
Yep.
Grab the shillings,
But Ramah,
pay your bank.
the question
done.
that has to be asked is now, again, I'm going back to the question I asked. Is a central bank within the dictates of the mandate that it has? Because the 2010 Constitution is clear about its role. Are they really doing what they're supposed to do, or have they moved outside the mandate that is given to them? Why don't I read it so that we understand what we're talking about?
All right.
According to Article 231 of the Constitution of Kenya 2010, the bank is responsible for formulating monetary policy to achieve and maintain price stability and issuing currency. And also, they're supposed to implement monetary policy decisions, manage the country's foreign exchange reserves, and manage the country's domestic debt. Kwa ufupi. In short,
that managing the country's domestic debt side is always an interesting one. They can do that because they're essentially the government's banking agent.
they're the country's banker.
Essentially.
Yes, they are. It's one of the roles.
They also have and when you talk about price stability, and price stability is always the bone of contention, right, related to what we're dealing with now with the FX market. Yes, you may want to have price stability, but price stability by introducing what effectively are controls on the market, you're not fixing the problem, you're creating another problem.
They're also the bank of last resort, and they're the bank for bankers. So,
Yes.
Bank, so the government, bank to the bankers. Are they failing the bankers in their role of being their banker?
Banks would say that by trying to artificially control the exchange rates, they're not doing their job. Because remember, as a member of the IMF, right, we also have an obligation to essentially ensure that we're not running a fixed exchange rate.
Yeah, who sets these rules?
We signed up to these things.
Yeah, but who sets these rules? Is there public participation? These rules are set by IMF
But
and
fixed can be,
Fixed can be fixed.
Yeah.
Even the fixed can be
So
fixed.
the law can be changed because the law is very clear.
Yeah.
We can fix it. It's a problem. We can fix it.